It does take us to our talk of the tape, the uncertain road ahead for stocks. Let's get the view of our panel today. Stephanie Link, Hightower's chief investment strategist and portfolio manager. Ed Yardeni is the president of Yardeni Research. Young-Yu Ma is with BMO Wealth Management. Our own Steve Leisman is our senior economics correspondent. And Steve, I'm going to begin with you because I feel like we got a Fed chair bounce today. And what do you think it was specifically that he said here in New York that certainly seemed to calm markets?
I think it was a generally dovish take, modestly dovish. So he talked about the idea that if inflation doesn't behave, well, we can hold rates. And if we have an unexpected weakening in the labor market, we can cut rates. Didn't talk about raising rates. But overall, Scott, listen to what he said here when he talks about a generally and very patient approach from the Fed.
Inflation can be volatile month to month, and we do not overreact to one or two readings that are higher or lower than anticipated. As we parse the incoming information, we are focused on separating the signal from the noise as the outlook evolves. We do not need to be in a hurry, and we are well positioned to wait for greater clarity.
Scott, obviously there's a lot of information to come. He talked about the idea of thinking about the all the policy changes administration as a whole, not just one. Talked about the idea that tariffs are really something that generally pass through, and ultimately was very kind of not alarmed by what's been happening. You could see what happened, Scott. There was no change in the outlook for the Fed funds future, so he kind of affirmed the market pricing for 3 cuts this year.
Stay with me, Steve. Let's bring in everybody else, too. I mean, Steph, it did not in any way sound like somebody who was all wound up about either, frankly, the state of the economy nor the tariff impact yet.
I think we were looking for an excuse to bounce, to be honest with you. We're way oversold. We all know about the uncertainties. We all know we're in a growth slowdown. We've been talking about a growth slowdown to expect in January, just simply because we don't have the fiscal tailwinds that we had from the prior administration. Obviously, we're all concerned about tariffs, on, off. That's kind of hard and a headache, to be honest with you. But we also don't know about inflation. We also don't know about the Fed. So the question is, how low do we go in GDP? We were growing 3% last year. Do we go negative or do we go 1.5%, 2%? I'm in the camp we go 1.5%, 2% because there still are a lot of tailwinds in the economy. I look at the consumer and I think lower rates helps them. Lower gasoline prices helps them. Jobs today were not horrible. Whisper numbers were 40 to 50,000, 151. It's slowing, of course. We were expecting that. Private jobs, 140,000. I was very encouraged about. Wages at 4%. And so, to me, the consumer is hanging in. That's the biggest part of our economy. I'm still in the belief we have a manufacturing renaissance as well, Scott. We haven't even scratched the surface in terms of onshore, reshore, and data centers. And you know I've been buying the infrastructure data center companies because they've gotten slammed. So I've been looking for opportunity. I had a little extra cash in the beginning of the week. I am deploying it. I deployed a bunch today.
I know you have, and I'll get to that in a minute. But Ed Yardeni, the price action today, interesting. Do you think it was the Fed chair that turned this market?
Yeah, it was nice to have a voice of reason and calm as opposed to all the noise to signal that we're seeing. The noise to signal ratio has really gone off the charts. And I think the markets are trying their best to kind of find an island of calm and reasonableness. And I think that's what we got today from the Fed chair. And I think his assessment of the economy was right on. I think the economy is actually going to turn out to be quite resilient. I mean, look, over the past 3 years, it put up with a tightening of monetary policy and didn't have a recession. And now I think it's going to be challenged and tested again by all this tariff turmoil. But I think at the end of the day, a lot of this is going to be negotiated away. The problem is negotiations should be behind closed doors where you can't hear all the noise and shouting. You just want them to come out and say, we've got a deal. And so it's messy, but I think we're all going to start getting used to the fact that it's going to continue to be messy.
It might. And Young-Yu, that's a good point that Ed Yardeni makes. This could remain messy for a while. So how are investors supposed to navigate that?
Yes, definitely. It's still a high uncertainty, high disruption. It's certainly the tariffs that are ongoing, tariff concerns are ongoing, but also DOGE spending cuts and layoffs that are also a disruptive force in the economy now. How do you navigate this? I think the first thing is to be patient. and not try to chase bounces when they happen. We do think that the market will gradually stabilize, but it could take some time because we have a timing mismatch between the disruptions that are taking place in the here and now versus when the Fed might start cutting rates by mid-year, and some of that benefit might come into play in the near term. We just have to face some of the uncertainty that remains and looking for opportunities, but I think being patient with opportunities as well is the way to go.